Hello and welcome. I'm Janne Muta, the Chief Market Analyst for TIOmarkets, and it is my pleasure to have you here so that I can help you with your trading and your trading questions. This is why I'm here. This is what I love to do. I love helping people. And if you tell me what you are struggling with, I can probably help you with my experiences. And if you're watching this afterwards on a video, maybe you can email us at support@TIOmarkets.com and we will help you with your questions afterwards also. But during this webinar, feel free to ask any questions at any stage, and I will take time for your questions. This is the whole idea here. Like I said earlier, it is a chat with traders, really. You are trading, I am trading, we all have the same experiences, challenges and problems. And because I've been in the business about 20 years, 22 something years, I will be probably able to help you. So you can ask me any trading questions you like, but let's keep them market focused. I can't go into all the details about all the financial assets, but let's stick to trading strategy, psychology, different kinds of markets, any practicalities that you find difficult when trading. And yeah, like I said, feel free to give me your questions as I go, and I usually come back to them. But first, let me remind you, we have a great trading platform, just razor tight spreads and no commissions per lot. There's no monthly fees either. So you basically get a very good trading environment. If you want to know more about this, go to TIOmarkets.com/contact. And when you are trading, and especially if you're trading actively, it really does make a big difference whether your spreads are like 3 to 4 pips or closer to 1 pip. And it's amazing how much you can save money if you trade with an account like this. But obviously, you need to be able to trade with an edge. And this is what we are here today. We want to know how we can develop ourselves, how we can get better in trading. And yeah, this is what I'd love to do today. My background, here's what I've been doing lately. Lately I am working for TIOmarkets, and this is my role. I'm in charge of market analysis and trader education. So TIOmarkets really has hired me to help you guys. This is what I'm here for. I want to help you to become a better trader. And in order to do that, I would need to hear about your struggles, because obviously everybody struggles. Everybody has problems in trading. The markets are difficult. They're not easy to trade. And if you just are if you're too shy to share about your problems, it's very difficult to get any help. So feel free to ask the questions, and I'm more than happy to help you. But before we move forward, attend this webinar only and watch this video only if you agree with this disclaimer, and especially with the fact that this is all just views, not investment advice. It's marketing material, it's basically educational material, and I'm here to help you, but I'm not giving investment advice. So watch this video only if you agree with this disclaimer, and attend the webinar only if you agree with me and with this disclaimer. So how do we start trading? Obviously, you need to have the first steps right. Obviously, you need to have a good trading account so that you don't pay wide spreads, and you have a reliable broker that you know that you can trust. And this is why I want to show you this first very quickly. Go to TIOmarkets.com and register for a new account. So if you are in the UK or Euro area, you choose the regulator as FCA. If you are outside, you need to choose the other options there. But this is obviously the step number one. And then you get your wallet ID emailed to you after you completed the registration. You get an email, something like this, and then you log into your personal trading account or a portal There you open a demo account and you download MT4 or MT5. So once you've done that, you get another email. Again, looking at this, there you have the currency, the leverage, the demo server, if it's a demo account, and you get your account number and you get your password. So basically, just to give you a better idea, I'm going to actually take you to the website. So let's go here. I have already logged in with some details here. And let's go to, basically, here's where you can open a live account, and basically the same procedure for demo account. You click on this, you choose your platform. I usually choose MT5, and for the account type, you can only choose standard when it's a demo. You choose your basic currency. There's usually USD also, but I have already opened a USD account here, so it's not listed here. You can choose, let's say, pound, for instance, and then you choose your leverage, and then you click demo account. Then that email comes to you. Then obviously you need to go to Download Center and download MT5. If you are using some specific indicators or EAs that are created for MT4, then obviously you need to go here and download the appropriate platform. And when you are ready to actually start trading with real money, this is where you can do the deposit or make the deposit, and just follow the instructions there. Cool. All right, but let me take this out the way now. Baharudin is asking if I could repeat back. Now, I don't know what you are actually referring to, but you can get all this on a video, so you don't have to worry if you missed something. This video will be afterwards emailed to you, or the recording will be emailed to you later on. But let's move on. One thing that I need to remind you, if you need to reset the password, if you happen to lose your password, then go here and go to account settings first and then reset the password. So it's very simple and easy. I have actually some sort of material prepared for you guys. It's basically about factors impacting trading psychology, because over these years, I've noticed that it doesn't make any difference if you give somebody a good trading strategy, but if the person's psychology isn't correct, that well thought out trading strategy doesn't help. So I have put down some thoughts on what is actually harmful and what is useful and helpful for traders' psychology. And why do I find this important? If you think about it logically, apart from clicking the mouse, trading is purely psychological exercise. It is something that happens between your ears. You do the analysis, or you read the analysis, you decide your trading strategy, you write your trading plan. All this is something that it's a mental exercise. And now if you ignore all this and just think it as something physical, something that involves the computers and screens and the mouse and clicking of the mouse and the charts and the data feeds, all this is just very, very small part of trading. All that impacts your P&L, your account growth, actually happens between your ears. And that's why this is so highly important, your psychology. Actually, Keketso is asking, how do you normally deal with emotions in your trading? Okay, we are actually going into that. It's a very good question. What else here is? Let me see. Keketso is also asking, what must a trader to do to ensure doesn't return profits? Okay. So if you make profits and you have a good run, how do you actually stop giving them all of them back? That's a good question. I can see that you have been trading and you have very good questions. Philip is asking, what's the lowest possible lot size one can use? Maybe we start with that one because it's so we can quickly answer this one. The other questions actually need a little bit more explaining. Okay, if you go to TIOmarkets.com and conditions, there you can find calculators, and there we have a pip value calculator. I'm going to show you this as well because some people were asking about this, but the simple answer to your question, Philip, is 0.01 lots. So if your account currency is USD and if you're trading Euro USD, then the pip value of this tiniest account size, or sorry, the tiniest trade size is 0.1. So it's 10 cents. So basically, the way this works is that you have one full contract and then one pip movement in the market is $10. So if you, I'm going to show you here. So if your currency pair is Euro USD, and again, deposit account currency is USD, and you are buying, let's say that you're buying at 17.10 and you close your trade at 17.20 and you have one lot, one contract. That's basically one standard lot, meaning that you are handling $100,000 worth of currency. That basically, this should say actually $100, but we have too many decimals here. So basically, that's what you get with one contract. If you want to trade with the smallest size, one micro lot, then that 10 pip movement in the market is worth $1. Hopefully that makes sense. Then we have mini lots, which basically means that for every 10 pips, you are making or losing $10 if you're using this. So that's how it goes. So you have micro lots, 0.01, full lots, and then you have mini lots, which is 0.10, and then you have the full lot sizes. You can use this calculator for other types of calculations also. Let's say that you are trading 1.5 lots and the market moves that 10 pips. Then this is how much you would make if the market moved in your favor. And again, this should say $150. Now, how much cash do you need to have on your account is the next question. Really. So let's say you want to trade. Let's say you want to trade one lot, and your leverage on your account is 1 to 30, or it's 30 times leverage. Then you need $3,900 on your account in order to trade that one lot. If your leverage is 1 to 100, I'm meaning that you have 100 times leverage, then you need only 1,100 or slightly less than 1,200, $1,170. Okay, Hopefully that helps you guys. Oh yeah, you're most welcome. I'm going to give you them here. So you have the link to the calculators there. All right, but there's actually also another way of calculating how much risk you are taking when you are trading. Let me take you to a chart here. This is pound USD, but let's go to Euro USD. And I'm going to go to 5-minute chart just to give us some, just to make things a little bigger here on the chart. Okay, so those that are very new probably will find this useful. If you have been trading for some time, you might just take a cup of coffee now. But basically, if you right-click on a chart and then go to trading and you set buy limit 1, and I'm going to go a little lower that it doesn't trigger because I don't want this to trigger. I just want to show you, I'm basically here using this in order to show you what you can do, how to figure out your risk for the trade. So you right click on this line. Basically, this is a buy limit. You have a limit order to buy one contract there. And then you want to know how much risk is there in this position. So right click on this line, go to modify, and it opens up this box. Now, if you press here, it basically creates a sell stop line. So I'm going to place it here, just a few pips lower, and click modify. Now, if I take my mouse on top of this, I know that because I see that little box there, I know that my risk here is $41, right? So this is an easy way to decide how much risk you have in the trade. If you go to the hourly chart and you want to, okay, this is not a good example here. Let me do this the other way around. I'm going to delete this. Again, just right click here and delete. Let's think about a short trade. And I'm going to take the 15-minute chart. Okay. So let's say that I'm not saying this is a good trade. This is just something that I make up, but I'm seeing a resistance level there. The market rallied to it and was forced down. So we have a resistance. Let's say that we want to have a short position here if the market comes to this level. And I want to basically use a mini contract, 0.10. If you click here, if you type here 0.10, then the way this platform works is that once you click on the right mouse button, you get the same contract size here. You remember earlier there was one contract, now there's just 0.1 contract. So if I do this, I also have an option to place these limit orders. So remember that the sell limit is always above the market price and buy limit is always below the market price. And also the same applies to stops. So the sell stops are always below the price and buy stops are always above the market price. But now we have 0.1 contracts there. And we want to modify this. We click, now we want to have, obviously, if the market moves to this price, then we have a short trade, then obviously the stop needs to go above this. Okay, so let's place the stop there and click modify. And now we have this distance here between the stop and the entry and the stop. So this is 5.6 pips. And if we leave the mouse there, it gives us, the platform tells you how much risk you have in this trade. So 5.4 USD. And what you can then do, if you're happy with this stop size, if you think that's big enough, if you know, I'm not saying it is, but I'm just saying if you think it is good enough, then you just drag this down to your level. Here it is. So now we are ready to take a short position there, risking about $5.50 if the market goes there. Then obviously, as we are dealing with this, let me just quickly show you how to create a target. So here's the take profit window. You keep on pressing lower, and here you can see how that TP line moves. And then you click modify. And let's say that you want to cover this trade around where the current market price is. So now your risk is $5.50, and your potential profit is $11.50. So about 2 to 1 risk to reward to risk ratio there. So this line or this order and this order don't trigger before the market actually goes to this entry level, the sell limit order. Only once the market has penetrated it, it becomes a market order, and after that we have a stop and a target in place. Nelson, hi, yes, you do. At the end of the webinar, we will give you, or I will give you the code. So patience, my friend, patience. All right, any questions on this? This was rather basic, but I mean, we have new traders here. We want to help new traders. So obviously you need to know how to set up trades. While you might be typing in your questions, I'm going to mention a couple of more things on this. So if you want to be a buyer, if you want to use a buy stop on a breakout, say you believe that the market, if it moves beyond this line here, if it starts to rally from here and goes up there, and you think you want to be a buyer on this breakout, I'm not recommending it, but if you want to do that, then the way to do it is to right click here, and instead of sell limit, we choose a buy stop. And now if the market moves beyond that level, then this order becomes a market order and we have a position. So we need to protect our downside. So we can right click or double click on this, and then again press down here to get a stop level, which we can then modify the way we want to do it. So let's put it down there. We're risking $23 roughly on this trade. Again, these are just examples. This is not investment advice. I'm not saying the market is likely to do this. I'm just saying this is how you do it. Okay, any further questions? Or shall we move to what let me see, there was somebody else asking a question. Kiketsu was asking, how can we ensure that the market doesn't take profits back from us? That is actually rather deep and wide question. Okay. Okay, Obaking, thank you for your question. Let me come back to it in a moment. But first, how do we stop the market from taking everything back from us? That you know, we make 5 or 6 good trades, we make a few $100s, and then we get a losing streak. We might get another 5 or 6 losing trades in a row, and if we are risking 1-to-1, then all the profits are gone. So there's a way to handle this. It's not a simple answer, but it comes down to the strategy that we trade. all the strategies would need to have certain elements in them. And one of the elements is that when we trade, let me go to the hourly chart. So one of the elements is timing. I'm going to use this tool here, and let's make this a level first. So I'm copying these, and I'm okay. Now we're ready. So let's say that we recognize that there's a resistance, and here's a resistance. So we draw a line there, and now we need to imagine that the time is there. This is the latest bar that, from everything on the right-hand side of this vertical line just doesn't exist yet. So we place this resistance level there and decide that if the market goes there to the level again, remember that we are here. So if the market goes to that level again, then we sell this market. Okay. So what happens? The market moves slightly up and hits our level there. So we go short. Let's say that we sell short one contract. Oh, that's a actually beautiful trade, but the hindsight is always 20/20. Now, in order to survive in the long run, our profits and losses would need to be in a certain, there should be a certain kind of relationship there. So let's say that I'm using this line here, and I'm going to make this red just to highlight that this is my stop level. Okay, so when we go short here at 1764, we want to place the stop not too close, because then we just get taken out and then the market goes down without us. So we want to place this a little further away. So let's see how many pips there is between entry at 1764 and the stop at 1782. So that's 18.3 pips, which makes $183 per one contract. So if, obviously everybody has different levels of experiences, and different traders have different levels of experience, and they have also different profit and loss distributions. So if you are a very experienced trader, you might have a 60% success rate. Some of exceptional traders might have as high as 65 to 70%. So that means for every 10 trades, there'll be about 3 to 4 losing trades. But if you are learning, and if you're not very developed yet, your success rate might be somewhere between 40 and 50%. If you're just a beginner, you might have 30% success rate. But let's assume your success rate is about 50%. So then if you just keep on risking 1-to-1 on every trade, it means that you are likely to just keep on losing money and then making money, and keep on losing and making money. And at the end of the day, after 100 trades or so, you just haven't made any progress. You just have paid some fees to your broker. So to avoid this, we should make sure the winners are bigger than the losers. And with the markets, we really can't. There are things that we can control, and then there are things we can't control. So one of the things you can control is how much you risk per trade. So how much you allocate to this trade, whether you allocate 0.5% or 2% or 1% of your trading account, and how far from the entry level you place the stop. So these two factors you can actually have control over, but you can't control the market, how far it goes from your entry level. But actually, third thing you can control is how far from the entry you place your profit target. So if you place it somewhere here, I'm actually going to use this arrow to make sure that I get these measurements right. So if you place your target here, you get filled pretty quickly. But how much is your risk to reward at the moment? Can somebody tell me? Watching this, how much is your risk to reward ratio at the moment on this trade? Anyone? Just a simple answer is enough. Is it 3-to-1? Is it 2-to-1? Is it 1-to-1? Sim Shiva, thank you. Yes, it's 1-to-1. So we do not, if we have 50% success rate, we don't make money with 1-to-1. So risk to reward ratio, or reward to risk, I should say. So we need to have a bigger ratio. So let's talk about at least 2 times the target compared to the size of the stop. So that's, if you wait this far, you're going to have better chances of making money overall if your success rate is 50%. If you are more patient and you have 3-to-1 reward to risk, then your success overall money-making potential is obviously bigger. Now we're talking about 50 pips, and that's with one contract. It's quite good. Okay, does this make sense to you guys? Let me know what you think. Is it okay to think in terms of risk, reward, success rate? Obviously, we need to take in, there's something else to take into account. We're going to go into that very soon, but can you understand what I'm trying to say here? How many of you do understand what is success rate? Let me cover that first. Just give me a quick yes or no. What is meant with traders' success rate? Anybody? Yes, Barbara, Shipiva, very good, excellent. I just want to have a kind of idea what kind of people are there, if I'm actually able to communicate this clearly enough, etc. So this is part of the answer. Oh, Pinaki, you need more explanation. I'm going to give you a very brief explanation on this, and then Pinaki, you can watch this recording later on when you get it on via email. So success rate means that if I make 100 trades and 60 of those are winning trades and 40 of them are losing trades, then my success rate is 60%. If I only make 20 successful trades in terms of P&L and 80 losing trades, then my success rate is 20%. And the lower your success rate is, the higher your reward to risk ratio needs to be. So this is something that you might want to think about a little bit. But if you are not very successful trader yet, if you are new, then you should stay away from very small time frames. Salomon is asking, what's the best moving averages to use in trading? Okay, I'm going to come back to this in a moment, but let me cover this first. Basically, because of what we just discussed about the relationship between the success rate and the reward to risk ratio, it makes sense that those with lower success rate try to catch bigger moves. So if you have very small risk to reward ratio, if you have very small success rate, say 30%, 20%, in order to make money, you really have to go to bigger time frames and catch the bigger moves. So that, if you have 8 trade, you trade here 8 times, you lose money, then you really want to catch something like this to make your account profitable. Obakeng is saying, I would think 1-to-1 risk ratio would have more success rate than a higher risk reward ratio, wouldn't it? You're more likely to hit shorter target than the higher one, statistically anyway. Oh yeah, that's a very good point. I can see that you have been trading and thinking this through. Yes, I was pointing this out from the sort of perspective of a new trader, and obviously there's lots of moving parts here. If you have a low success rate, then 1-to-1 risk ratio can be difficult. But if you get your success rate higher, then you can take more of those small, quick profits. At the same time, though, it is I'm just thinking here. You said, Obakeng, that statistically speaking, it's more likely that you get the shorter or the target that is closer. Yes, but it depends. It depends on your timing skills. Because if you don't have timing skills in the equation, then statistically you're more likely to get just random amount of losers and winners, and then 1-to-1 risk ratio is a little bit challenging. So, but if you add some timing skills into this equation, then you are probably more likely to have a higher success rate with 1-to-1 risk ratio. But then you should also ask, are you actually performing at your best with that ratio? i.e., does that strategy make more money with a different risk to reward ratio? Or is it okay? Then somebody might come and say, we do understand all of this, but what about psychology? And this is actually something highly important. If you are a person that usually in relationships or your work life, if you have a need for constant affirmation, constant positive feedback from people, then you might find it difficult to trade a longer sort of strategies that take swings and positions in the market for a longer time period, because there are usually lots of losing trades involved, and then the money is made in fewer big trades. And some strategies actually make more money with this setting. So there are investment funds that make millions and tens and hundreds of millions collectively just by riding the trends. But if you are a trend trader, it usually means that you try to, you think a trend is starting, and you take a trade and you get stopped out. Then you think, okay, now it's going to start, and you take a trade and you get stopped out. And this might repeat 4 or 5 times before the trend starts. But when it starts and moves, it moves so much that all of those little losses, provided they were little losses, provided you had a good a risk management there, all of those little losses are covered and the system makes money. These are sometimes more effective in terms of the total money made or the total profits generated than very quick, small trading strategies. But anyway, we've spent quite a bit of time on this, so let's move on. Solomon was asking, what's the best moving average to use in trading? I don't think there's best of anything, really. There's no best strategy. There's no best moving average. There's no, just like there is no best car in the world, there is no best moving average or best trading strategy. So if you say there might be a best car for you, for the situation you are in, for the purpose that you need the car for, there might be the best car for that, but there isn't the best car, absolutely the best car in the world, because it comes down to the criteria. But let's look at moving averages here. I have a 50 period moving average, and the benefits of this is that if you use it, it tends not to give you false signals. If we change this and go to, say, 10 periods, it tends to move and react to the market a little quicker, and there can be more false signals. But then on the other hand, the advantage is that you get an earlier reversal information on the market. Let's make a very simple rule. Let's say that we want to trade short when the moving average is pointing lower, and we want to trade long when the moving average is pointing higher. So starting from here, we have a period where the market is moving higher. It looks good. Then the moving average turns down, and so from about here we would be short, and then we have a blip higher there, which is a false signal then in this system. We go short again, but we can go short only, I think, here or on the close of this bar, because obviously the moving average needs some time to turn. And then if we go long once the moving average has turned higher, like somewhere here, then we are actually going long over here on these bars. So there would be losing trades there. So you can see how there can be lots of signals that are false, and you need to figure out how to avoid them. And one of the ways to avoid them is to have a moving average in a higher, say, let's make this, okay, this is 50, and now the swings are quite sort of slow, and you just need to find a way how to use it properly. And if you go to hourly chart, you can use a 50 period quite often. And let me take it back a little bit. So in the hourly chart, if the 50 period is moving up and the price primarily stays above the moving average, then we have bullish momentum in the market. If the moving average starts to move sideways, then we most likely have a sideways moving market. If the moving average moves down and the price is below the moving average, then we most likely have a downward trending market. Now, obviously, there's other indicators you can sort of throw into the mix. You can take another indicator and let's go here. Moving average. I'm going to make this a 20 period. So now you have a new possibilities for your rules. You can say that if the red is above the blue, if the fast moving average is above the blue, then you can either go long as soon as the crossover happens, or you can add some more sophisticated rules. Say, for instance, that when this is in place, you can look to buy pullbacks into the moving average. But then you have to deal with things like, okay, if it pulls back to the moving average, is it actually going to bounce up already from the moving average or move a little lower? And not quite often, like you can see, it happens to move below the moving average before it can go and move higher again. So one way of tackling this is, let's go here, because this is, in trading, nothing's too easy. One way of tackling this is to bring market structure into this and say, okay, here we have a resistance area. So let's only buy the market when the market comes to, oops, let's make this a little different. I'm going to make this solid and wider and blue. So now we say that we are going to buy the market when the fast moving average is above the blue and the market comes to a support level. So that's a good entry and works again here. Somebody else might say, okay, I'm looking at this and I like the bullish indications here, and I want to use the stochastics 5, 3, and 3. So if this is true and the stochastics goes into oversold area, then I want to be a buyer. So here's one buying opportunity. Here's another. There's the third one and the fourth one. So as you can see, some of these are highly successful, like this one. There's about 63 pips there. Then some of these are good ones, but fade quickly. That's about 10 pips. And we have another one here. Oops. That's about 20 pips. And then finally, we get a move that really takes the market high. That's about 120 pips. So I'm basically explaining this in order to help you to understand that there isn't just one simply the best idea for the markets. You have to look at different indicators, go back in the charts and see how they would have worked. How well the strategy would have worked in downtrending markets, sideways moving markets, uptrending markets. So all of these are obviously different environments, and indicators and markets behave a little differently. All right, does this make sense to you? Again, let me know, what do you think? Is it something that you can understand? Maybe you have some further questions on this. Let me know. While you do that, while you type in your questions, I'm going to look at the other questions here. Simshipway is saying that I personally don't take a trade if it's not 3 to 1. Okay, 3 to 1 is a very good. It's kind of classic. A lot of traders use that. But I would say, look at your trading results. Go back your trading history. See what kind of trades you have made. And based on your own statistics, decide what would have worked the best. If you have good records of your trading and you can see that your success rate is X, then go and see what happened in the markets after your entries to see if you should have actually kept the trades longer or if you should take the profits earlier. So with your winning trades, see if you should have kept the trades longer, and with your losing trades, see if you basically should have taken them off earlier, and try to figure out what's the best. There's always kind of optimal setup for your own, based on your own history, but there isn't a one single best answer that fits every trader. Okay, Solomon is saying I'm okay with the explanation of moving averages. And Obaking is saying that it makes sense. Very good. Glad to hear that. Most financial reporting agencies often comment on breaks and bounces of 200 and 100 EMAs. How significant are they from a macro point of view? And I think that you might be referring to higher time frames with the use of word macro. A lot of people use the word macro for macroeconomics, which obviously is a different. It's something totally different. It's not about technical analysis. Okay, I find that I don't really pay that much attention to them. I haven't, to be honest with you, I haven't studied enough in order to give you a good answer. And I basically, it's not that I'm lazy and I'm not interested in these things. It's not that. The reason I'm saying that I haven't studied this is that I really don't pay that much attention to financial media. So it's the financial press and and television, excuse me, that really hasn't in-depth understanding of markets. They are journalists. It's their job to write something decent, and they haven't. In most cases, I think they haven't studied the markets in order to say something that really helps the traders. So you can use the financial media just to get an idea of what's in the news and what markets might be moving. Let's say that if you can see that OPEC is saying that we are going to actually cut the production drastically, then you can expect, obviously, the price of oil go higher, but you can expect the Canadian currency go higher. So USD CAD would be then a bear candidate. So I use financial media for that sort of things more. In terms of 100 and 200 EMAs, let's take a quick look if they make any sense. Is a 200 and this we're gonna make 100 periods. So, okay, so here the moving average actually acted as a support. Then it was penetrated, then it was penetrated. This is often the problem with these. I mean, if you report this in your newspaper article and say, okay, the 100 period was penetrated, and then the 200 period was penetrated, are you going to then also report that the 100 period was penetrated here and here and here? Does it actually mean anything? I don't think it does. Here we had a move below this 200 period and the market just quickly turned higher. You could say that it sometimes gives you something to trade with. Its market goes above it and then keeps on going higher. But I think there are better tools available. Solomon is asking, how do you actually know that your broker is trading against you? I really don't pay any attention to that idea. There's a lot of speculation, people saying that it's bad if the broker is trading against them. But the fact is that everybody is trading against you. I mean, there might have been in the past some situations where a broker somewhere was dishonest and moved the reported false prices, and maybe that's the origin of this sort of idea that we should be worried about traders trading against you. But if that happens, the broker is caught very quickly because all the price data is public. You can see where the EUR/USD is trading. So if you see all the other data feeds giving you this price feed, and then suddenly there is something totally different, the market starts to go there instead of going down, I mean, that's silly. Everybody will know that this happens just looking at the price chart, and then the broker is out of business. So that doesn't make sense. So at the moment, for the time being, I've been in the business, I haven't seen that happen, and it certainly hasn't happened to me. But the fact is that everybody trades against you in the market, and that's what you should be worried about. But if you focus on selling at resistance levels, like here, this was a resistance. When the market comes back to this level, and if you don't try to buy the breakout, but sell against the resistance, then you don't have to worry about even the big funds trading against you, because they are probably selling the market at the time. And that's what you should focus on. Then let me see if I can find you another example. Here, there was a support. And when the market came back to the support, guess what? Everybody was buying there. Everybody with big money was buying there. So the only way you can get yourself into real trouble is to actually try to sell at supports and then buy at the resistances. Obviously, eventually every resistance is going to give in, but most of the time, 1, 2, 3, the resistance levels are working in your favor if you are selling against them. So that's one big helpful sort of nugget. Somebody told me this years ago, and it's been immensely helpful. Don't try to fight the market. Don't try to fight the supports and resistances. Does TIOmarkets sell order flow to liquidity providers like Citadel? I haven't heard of this. No, I don't think this is, you're saying it's uncomfortable question, but I don't think that is happening. I would have heard about it. It's not our business. It's I know there are brokers like the what's it called, Robinhood, that actually does it, but I think they are open about it and they do it with, you know, customers knowing, unless I'm badly mistaken. But yeah, so what you need to focus is on the market, not the broker. As long as you have a reliable, regulated broker, then you should be fine. There isn't any reason why you should be concerned about the broker trading against your orders, because somebody is always taking the other side. I mean, you can't trade if there isn't somebody taking the other side. And I guarantee you, if you are losing money in the markets, that's because most of the time there is a big institution, a bank or an investment fund or a very professional trader taking the other side of your trades. Yeah, Bucking, you're right. It's perfectly legal. I mean, take for instance Robinhood. They are listed in the NYSE, I think. I haven't checked, but they had their IPO just lately. If that wasn't legal, they wouldn't be able to do that. What's meant by institutional level? Can you clarify, Barbara, a little bit what you mean by this question? What do you think institutional level might mean? Is it referring to trade levels or the market support and resistance levels? Okay, let me see if I have missed any of the questions while Barbara is typing her question. I think there was one question that I have missed in the very beginning. Okay, let me see. Okay, so Keketsa was asking, how do you deal with emotions in your trading? That's a tough question, and it is, you know, emotions are very difficult. Okay, let's go to the material that I put together for you guys. So, because it deals with emotions, especially with emotions. So, factors impacting trading psychology, and it's really about your emotions. Your emotions are a big part of your psychology. Barbara, as I don't see you typing your sort of explanation to this question, I think it might be referring to some very high level support and resistance levels. So just quickly going back here, this is a daily chart. So the fact that the market came down here and then started to rally this much, it tells you that this sort of reversal in the market was created by institutions. So you could call this as an institutional level, because small traders just can't move the market like this. It's the institution. So we could say this is an institutional level. I'm just making a guess because I'm not exactly familiar with that expression, but it makes sense to me to think this as an institutional level. There is another one here. If we go there, the market moved down from there. This obviously happened with institutional selling. So if we can side ourselves with institutions, we are much, much better off. And that's why I'm saying, usually saying to new traders that you should trade with daily charts, trade the daily support and resistance levels, because they really can't be manipulated by these big funds. By manipulation, I mean Let me find you a good example. Okay. What's a good example here? Okay, that's pretty much even. Okay, maybe this helps you to understand. People talk about market manipulation, so this is one potential explanation for this. So we have a resistance level there, and then we have market moving above it, and obviously a lot of new traders, they like to trade breakouts, so they actually go long here, and then the market suddenly turns down. So obviously nobody knows exactly why this happens. There are different theories. One of the theories is that this is big institutional money manipulating the market, driving the price above the resistance level so that they have liquidity which they can use to go short on the market, and they would be basically selling here because the small money is buying, the little traders are providing liquidity for them to turn around and go short. That's one explanation. Okay, Barbara, you're saying that sometimes it's referred to as 0 level. Sorry, I don't know that. I need to go and Google and see if it makes sense to me. Maybe I'll come back to this the next time. But yeah, so these false breakouts, they are often referred to as institutional sort of manipulation of the market. There's probably another example. We have a support there and the price is pushed below the support and then it turns higher. So that's one sort of take on it. But let's go to the psychological factors, because this is a major stumbling block for many traders. It's been a difficult one for me. There was a time when I thought, okay, I'm done with it. I'm actually good now. I don't have to worry about this anymore. So let's cover at least some of the material. I know we've been here for an hour already, but let's just quickly cover some of the material I have ready for you. And then in the future webinars, I'm going to cover the rest, because so many traders ask about emotions and trading psychology. So it makes sense to cover this area of challenges. So one of the problems is that traders tend to trade too many markets. When I started, I had literally 16 intraday charts open on my screen when the Nasdaq opened. I was trading stocks and I was just frozen. I couldn't cope with it, and I don't think anybody can, unless you are somebody with very sort of well-trained into following small intraday charts, and you have very good preparation procedure behind you for that day. You have found your levels, you have researched your stocks, you know exactly, you have very good idea of where the major support and resistance levels are. Then maybe you're able to do that, but most of us can't. I rather concentrate on one or two markets, and that makes so much more sense. I have to admit that I rather just make this as easy as possible. So I just want to trade one market at a time, maybe two, but it's most of the time I'm monitoring 4 or 5 markets which I have researched, and then I'm trading one of them at a time. Maybe there's positions in 2 of the markets at the same time, but that's maximum really. Then too many trades. This is the problem I have had and many traders have. Why do you want to have so many trades? Or why do we want to have? I don't know. It's just the the feeling that we have to be clicking the mouse because we are traders, right? It's silly, isn't it? We keep on trading because we think we are traders. Think of yourself as a risk manager, rather. Try to think like an institutional trader. Your manager has given you a risk allocation for the day. Say that it's 5% of your account. And you have to manage this risk allocation so that you can make as much money with it as possible. So you need to limit the number of trades per day, because that leads to a higher quality trading. You can't, let's say that you have chosen to limit your trades to 3 or 4 per day if you are an intraday trader. If you only have those 3 trades per day, then you have to make sure they are at the very best possible setups. And sometimes it might happen that you just don't get the trade. The setup just doesn't come together during the day. So you might not trade at all. But if you keep on clicking the mouse, you get very emotional, you get into revenge trading, you usually make bad decisions, and your emotions come up, you get frustrated, you just want to make it all back, and suddenly your mindset is just a gambler's mindset. You are in a casino trying to make your money back, even though you know that the house has the edge on their side. As long as you don't have very solid statistics that you have the edge and not the market, then you should be very careful. Okay, so limit the number of trades per day. Wow, too much size. This is one of the big, Shimp even is saying, yes, too many trade, my current problem. I tell you, I've been there. I know what it feels. Try this. Decide that you only have 3 trades per day. And you wait for the best possible setups. And you trade like that for 3 weeks. And then you look at your results. You might even have your real account for your system, your strategy that you believe has an edge, and then you have a demo account for all the testing and tinkering and trying, because I know the feeling. I want to try if this works out. And how do I try if I don't click the mouse? But my solution is I have another account for testing and trying and one account for real trading. Okay, so too much size is one of the biggest issues that traders have, because they are focused on making money, not creating a good trading process. I say this again. Most traders are focused on making money and making big money instead of making sure they have a good, solid trading process. Your proceeds from your trading account are a clear expression of, or just one-to-one output on the quality of your process. So your process defines your outcomes. And most traders try to take this shortcut by trading big. I'm going to make more money because I'm trading big, but actually you are going to lose more money because you trade big. That's interesting, isn't it? You're going to lose money because you trade bigger. That's because it's impacting our mental capability. I have a friend who's a psychologist, and she said that trading is a funny business because there's this dependency issue. The more you are dependent on trading, the more likely you are going to lose money. The less you are dependent on the trading and its results, the better chances you have to make to actually make money. Oh yes, guilty as charged. I know, being there, done that. So actually, let me move on. I'd love to chat about these things, but I need to move on. So, no trading plan. This can be a big source of many emotional problems. So write a trading plan and keep on reading the trading plan every day of the week, as long as there are no deviations from the plan. Most traders trade without a trading plan. And guess what? Most traders lose money. Then there are traders who have a trading plan, but they don't follow the plan. And guess what? They too lose money. So do whatever you can. Use the 2 different accounts. Write the trading plan. Renew it. Rewrite it every time there is a need to rewrite it, but have a plan that you follow. If you don't have a plan, you can't measure the results. If you're doing this today and something else this afternoon and something completely new tomorrow, then you are just a mess as a trader. You need to have a good, solid plan that you follow. And if the plan doesn't work, then you go and think about it. You analyze it. You look at the results and you go and see in the markets what would have worked. And then you alter the plan accordingly. And then you follow the plan again. Okay. Oh yes, plan your trade, trade your plan. Everybody knows that, but how many actually does this? It's amazing how many people actually believe that has some value to it, but then they kind of think that they themselves are exceptions. So switching from one approach to another, this is another big problem. And Mark Douglas in his book suggests this brilliant solution. Think about your trading as a sort of sequence of trade blocks. So you trade your plan with 20 trade blocks. And after each of those, you see how well you were able to follow your strategy, how well the strategy fared. What was the market like? Was it ranging? Was it very choppy? Was it very quiet? Was it upward trending, downward trending? And then you can do some real analysis about your trading and you can develop as a trader. And also, this ties into the question that somebody had earlier about how do I make sure I don't give all the money back to the market? If you have the 20 trade block that you are going to execute next, then you can decide, okay, I have 10,000 on my account. How much money do I want to have on my account in case the worst of the worst happens and I lose all of the 20 trades? So always think from the risk perspective. That's what the professionals do. And why is that? Because the professionals, they manage somebody else's money. So they have to focus on what's important for the client. And the client wants to know, how much risk do I have to take? And what are the risk factors in the style of management that you are going to use when trading my money? So you can think like a professional and decide that after 20 trades, if everything goes according to the worst case scenario, then I want to have 8,000 on my account. So the account doesn't go down more than 20%. Then it follows that you allocate how much per trade? 20 trades, 20%. The answer is obviously 1% per trade. So you don't risk more than 1% per trade. So that's one of the ways to ensure that there is control in what you do. And you need to have that control because you don't have a boss looking over your shoulder and asking, why did you do that? Why didn't you follow your plan? You are your own boss. And that's what it takes to actually, you have to manage yourself in order to make it in the markets. Here's another solution that we already talked about. 2 accounts, one for making money and the other for testing new ideas. If you go and read the Market Wizards books, one of the highly successful account managers there or traders actually used this approach. He had this mind of an engineer who wants to test things. So he had another account for testing. And then you can compare these 2 accounts and see how the P&L curves are actually developing on these 2 accounts. And then you get more encouragement to actually stick to your plan. All right. One more. If you don't do any after trade analysis, how do you think you can actually develop your trading style better? I mean, we need to always measure what we do. If you constantly fail in something simple, let's say that you constantly fail to please your wife or your husband, obviously at some stage you need to do some analysis on your behavior and on how you speak to him or her, and then you can alter what you do, because obviously you don't want to have a bad marriage. If you want to have a happy marriage with Mrs. Market, you have to learn a couple of things. You have to learn to obey the Mrs. Market, not to trade too big, to follow your plan, and to make sure that you have an edge. Otherwise, Mrs. Market will take all your money away. So analyze your trades after each of these 20 trade blocks. And this helps you with your process, because the process is the most important thing. Some people, traders often do this. They just trade the same way, whatever the results. And year after year, they say, okay, this used to work, but it's not working anymore. What's wrong? What's wrong is that you are sticking to something that worked years back, but doesn't work anymore. You need to change, man. So adjust the plan after each 20 trade blocks if that's necessary. Do your research, study the results, see what else can be included in your plan, as long as you make it methodically, just so that you are developing yourself as a trader. And I think we can finish here now. I'm actually going to cover the rest the next time. And meanwhile, if you have 1 or 2 questions more, I can take those and then we finish for today. But this is a big one. While you type your questions, let me talk about this. If you focus on the results, your trading life is going to be just a misery. It's so awful to focus on the results, because there'll be lots of negative results. If you are one of these people who loves to have other people saying, okay, you did this well, you are such a good person, you are such exceptional. Maybe your mom used to talk to you this way when you were a kid, and now you expect everybody to do the same. Otherwise, you're not happy. And then you go to trading and you expect the market to do the same. And it is quite problematic, because the market's going to tell you exactly what it thinks about your trading strategy. So instead of focusing on the results, focus on the process. And once you start focusing on the process, then you can start really developing as a trader. If you just come to your desk and try to make money every day, you're doomed. Trading isn't about trying to make money, right? Trading is about executing a strategy that has an edge. So focus on the process, because only the process can give you the strategy, can give you the discipline, can give you the understanding of the markets that eventually enable you to have the financial freedom that you want to have. But if you start the whole thing wrong way around and focus on the money, on the big trades, making a lot of trades, you are focusing on the results. And then your mind goes up and down, your feelings go up and down, because when you're making money, you are so excited. And when you're losing money, you are just so desperate. But that's wrong. That you don't want a life like that. I don't want a life like that. I want to focus on the process, because the process, the better it is, the quicker I am growing as a trader and reaching the level that I want to reach. And by the way, there is no you don't ever arrive as a trader. There's always a process of learning. And once you've learned something, you can learn something new. It's a cumulative process. Okay, how do you know when to close a winning trade and when to leave a winning trade? That's a difficult question. That really is a difficult one. I would say there is no simple answer to this. It really depends on your results. When you look at your winning trades, like I said earlier, go back and look at your winning trades. First of all, make notes of every trade that you do. Take screenshots of your charts. Write down the reasons why you took the trade, why you exited the trades, and then go and see afterwards. Say you have traded 50 trades and you have the data of those 50 trades. You can go back and see what happened after you exited those positions. If you start to notice that you only take 10 pip profits when the market actually moved on average 30 pips, then you know what to do. If you notice that you try to catch 80 pips and you actually end up with 25 pips after the market has pulled back quite a bit, then you start, maybe you want to do a study and see if there's something, if it would have made sense to take 40 pips or 45 pips instead of trying to get the market into, to move 80 pips and then it just reverses. Check where the significant resistance levels are if you are going long. Check where the significant support levels are if you're going short. Oh, thank you, William. Excellent. William Jones is saying, great presentation. Lovely. Thank you. And Pinaki, I like to know the strategy to set a lot size and set stop and loss. Okay, there's loads of different ways of doing this. But let me go to the charts. So let's say that this is where we are. And we identify this trend. The market is moving higher, making higher highs, higher lows, higher highs, higher lows. So clearly the market is moving up. It's not downtrend, it's not a range, sideways range, it's an uptrend. So we want to go long around this support line, this trend line, when the market hits it next time. So let's imagine that we got long there and our account size is Okay, let's call it a $10,000. If I want to make sure I don't risk too much per trade, let's say that I'm trading those 20 trade blocks, and I want to make sure that the risk per trade is such that after those 20 trades, I have at least $8,000 left, assuming all 20 trades go wrong. Then what I do here is to place the stop for my trade. Let's say we opened it at 14.25, and I don't want to risk more than 1%. Then by doing this, I can actually get an idea where the market, where I have lost $100, which is 1% of $10,000. And it's there at 14.15, right? So let's place there a line. So 14.15 roughly is there. And let's see if I can make this bit a little bigger just so you can see better. So trade entry level at 14.25. And the exit 10 pips lower, so we are losing only 1%. But isn't this a little close? The market could easily come down here and take us out. If we keep adding the stops so close, it's quite likely that the market just blips down here, takes us out, and then keeps on rallying higher. So the solution is to double the stop size in terms of pips. Instead of 14.15, we go to 14.05, which is here. And instead of using one contract, we use 0.5 contracts. The risk is still the same. The risk is still the same. It's only, excuse me, it's still only $100, but we are further away from the market. So that's the way to decide how much space you want to have without actually risking more money. And the further away you take the stop, the less likely it is that the market moves into your stop. Say if it's here, that's 35 pips, and then you have to make the math or calculate how big of a position you can have if you are trading with a risk of $100. Oh, Keketso, thank you. Keketso is saying, great presentation indeed. Lovely, thank you for your feedback. There was a question about ATR. Yes, we can cover ATR average true range in the next session. Just to give you a quick idea what it is, it's an oscillator that gives you the average range over the last X number of bars. It could be 14 bars. And so at this stage, for instance, it was 24 pips. So looking back from this candle, we had average range from high to low of 24 pips. So that's one of the ways of looking at where do you want to place your stops. You can subtract from this trend line, for instance, because you're buying there. You can subtract the ATR value, which here is 27 pips. And then you just do the math and decide, using that risk allocation per trade, how much you want to, or how far you want to place the stop. Okay, trailing the profit. I think the best way to do that is to just manually take the stop higher. let's say that this is your stop level. When the market has moved higher and has created a higher low there, then probably you can take your stop, trailing stop there. When the market has moved yet again higher, you can move this the trailing stop below a reactionary low. So that's the way to do it. I'm not saying it's the best strategy, because sometimes you place them too close, the market comes down, hits your level, takes you out, and then goes higher. For instance, it could happen that you place your trailing stop there, thinking that, okay, it's below this low now, and then bam, the market comes there, takes you out. So be careful with that. Maybe you want to use ATR there, maybe you want to subtract 27 pips or whatever the ATR is at the time from the lowest low. Here it was, ATR was 24 pips. So 24 pips below this one is, let's see if it was enough. Yeah, it's there. It was enough just by, it's very close. It's very close. Yeah, it was enough there. But then you can use ATR multipliers, say 1.5 times ATR, etc. Okay. Yeah, the market is unique every time. You have to research the setups. One of the easiest things to do is to recognize when there's momentum in the market. See, we can talk about this a little more the next time, but when the market starts to break resistances, let me use this box as it's a little easier. When the market starts to break resistances, there's one, there's two, then you know that, and at the same time, it's creating higher lows. So then you know that there is upside momentum, and up here is more likely that the market's going to move up for a period of time. Obviously, it will turn at some stage, and you have to notice that momentum is changing there. You can use oscillator for it, for instance, like stochastics, or you can use RSI, whatever. But that's the way, basically, to stay in the markets that are that have momentum, that are moving. If the market is moving sideways, let's see if we have an example. Like here we have a resistance. Here we have a support, and the market is moving up and down between these. Then you can decide whether you are actually going to sell the resistance or just buy the supports because you have some momentum behind you. But it's always a question of learning to read the markets. But anyway, we spent so much time here now that I think we have to finish for the day. Keketsu is asking what are the skills required to work with TIOmarkets. Please email support@tiomarkets.com and we'll help you out with that one. Very good. So before we go, and as I give you the webinar, I'm going to give you the code, the promo code. Do me a favor. Please give me feedback. Basically, I'd like to hear if you got something out of this webinar, if it was useful. Tell me, why was it useful? Tell me what aspects really helped you. And obviously you can tell me if it wasn't that good and you just got bored and you didn't get anything out of it. I'm happy to hear that as well. And then I know that I need to improve somewhere. And you can obviously tell me where I need to improve. I love that. I love all the kinds of feedback. So please do that. Type your feedback into the chat window now so that I can have some idea on how you guys experienced this webinar. And while you do that, Okay, Olu, I basically said that if you could give me some feedback, that would be great. Okay, so here's the webinar code for you. And we just need to call it a day. Let me go and see if I can find. There's this. All right. So cool and friendly. Thank you, Pinaki. Yes, there are doubts and there are problems. There are things that are difficult. It's always with trading. It's a never-ending story. You need to just learn to grow a thick skin and always focus on the process. Okay, how do you use the code? Basically, when you go here, let me show you. When you go to the client portal and you go to deposit, there in the deposit form, there you can use that code and you will get the gift from the TIOmarkets. Excellent. About the expiry of the code, I really don't know. I haven't asked that ever, but can you ask, basically email support@tiomarkets.com and they will help you out with this one. Hey guys, it's been really fun here with you. Any maybe typing the feedback is a little tiring. Can you give me a number rating from 1 to 5? Give me 1 if it wasn't very good. Give me 5 if it was excellent, and something between if you want to. This helps me to understand where I am with my webinars and how I can help you guys better. Obviously, if you have ideas on the future webinars, what you'd like to learn, I'm more than happy to include your ideas in the future webinars. Yeah. Oh, Barbara is giving me 5. That's not allowed. Hey, Pinaki 5. Ifyani, sorry, it's too difficult name for me. There's another 5. Thank you for the feedback. Thank you, Olu, for the 5. Excellent. So, Muhammad, thank you. Opageng, thank you for your time. Thank you for excellent feedback. But really, if there's something else that you would like to include here, let me know. We have these webinars once a month, and I just love helping traders. So if I hear from you guys that you have been helped by these webinars, then I'm excited. Okay, cool. Yeah. Please come back to the next webinar so that I can sort of. There's no quick fix solution to anything in trading. So it's a journey that we go together, and you might have more questions by the next time we are together. And obviously I would love to be able to help you with those ones too. Hey, thank you for the lovely feedbacks. I'm honored to get your 5s and 6s and 8s. Excellent. So hopefully I see you soon again, and thank you for your time again.